today we're delighted to have Atul Arya from IHS Markit come for a second presentation on the outlook for the oil and gas sector and the energy sector more broadly with COVID and the turmoil that we've seen in the oil markets. So as I mentioned, he launched the series really on the 30th of March. So now 4 months later, it's fascinating to be able to reflect again, to hear from him, reflect again on what the outlook is for oil and gas and put that in context of the transition and renewables and see how his assumptions have changed with regards to the modelizations, where they see COVID, how they see COVID evolving, the global economy, the geopolitical risks that underpin market fluctuations.
March 30th was literally, 3 weeks into the crisis. So it was a very, very dynamic situation because we had the greatest decline in the oil demand ever, 22 million barrels drop, greatest volume of production cut. First time there was a deal, with the US trying to make a deal to keep prices up, which has kind of never happened. It's always been to keep oil prices down. We had, at least for a day, the closing price was negative in the US, the WTI. Travel, passenger road pretty much stopped for at least for a couple of months. Air travel is still very limited, and the future of air travel remains questionable. But the one thing to keep in mind is that air travel itself is important, but not super big share of the oil barrel. We reached the peak production in the US was around 13.1 million barrels per day total production in February of this year, and our forecast is that it will just continue to decline and not go back up. There are other places with cheaper cost of supply. Russia, as an example, is a big place with much cheaper oil, and of course the Middle East. So they will get at $40 a barrel. There are other options besides the U.S. shale, which can come online. So gas, natural gas, LNG in particular, we continue to see LNG as a growth business, and of course there has been slowdown in the demand growth this year because power demand fell, and for other reasons. Geopolitical tension between U.S. and China meant that China is not importing as much LNG. But the case for LNG remains very strong. The prices have been, very low, and that has put the producers at a disadvantage. One thing I should point out here in the case of LNG is that there's a lot of focus obviously on China and to some extent on India, but really there are other countries in Asia, Pakistan and in Thailand. There are other countries which will take Vietnam, which will take a big chunk of future growth in LNG because of the characteristics of LNG and the domestic energy. Here, in terms of spend, 700 billion was the top number. And then, of course, it went down to 50% of that in 2 years, which is the steepest decline ever in the history of upstream business. Overall, there is a secular decline in the upstream spend. And that should not surprise. It shouldn't be surprising because we have lowered the cost of production. Oil and gas is really a margin business now, and a lot of very cheap sources of oil and gas. And although I don't have a chart, the need for new exploration is decreasing by the day because we have lots of oil and even more gas, and of course, coal is not relevant here, but so hydrocarbons are plentiful. So a particular company or a country definitely could have a need and a logic for oil and gas exploration and growing production. But globally, it will have to compete in a global market where there are plenty of low-cost sources of both oil and gas into the future. Investors are soaring on energy sector and looking at the future and saying, do I really want to invest in this if I can get a better return in other sectors?
I thought this would be a good place to pause and ask people whether all the IOC investments that we've seen in like low carbon sectors, renewables, are driven more by sort of a greenwash in response to investor pressure, or driven by their expectations of profits and strong returns.
This year, when companies have cut 25% of capex, as I said earlier, majority of them have preserved their low carbon capex, so they haven't cut that. So as a share, as a percentage, that number has gone up. I think the one big question which we are seeing now, being kind of being debated, is how will the government spend their money? And Europe has clearly spoken that they are going to spend money on green recovery. US, not so far. The climate change is happening. We are seeing the impact of climate change, so action is warranted. There is real urgency. So that will drive companies, that will drive shareholders as well.
And putting that together with how the finance sector has now changed from focus on volumes and reserves as a measure of growth and future prospects, and requiring returns, is a fundamental shift that's also going to put some significant pressure on oil companies.
Question has to do with the current industry new normal. What should be the response of new producing countries like Ghana to this new normal in terms of investment attraction? We've seen some countries like Equatorial Guinea and others trying to revise rules and regulations and all stuff. What would you advise that for countries like that?
Yeah, this is a really important question and difficult one in many ways. But I think that the way I would frame it is that one is that companies will spend less money, private companies, IOCs, and less money on oil and gas, particularly the European ones, going forward, and they will then need to allocate more and more money to the transition. So in order to attract them, you need to have attractive terms, which would bring them in. And the second thing will be having the infrastructure, or being able to build the infrastructure quickly. How quickly can you get that oil to market or gas to market will also be very important.
NOCs, emerging NOCs that are common in our group, at what point do they need to consider diversifying their portfolio and reducing the risk of their oil and gas assets by going into green and low carbon investments?
Yeah, I think, again, a very important question. I will answer it in two ways. One is that, who is the current competitor in that space? So if you have a national electricity company or other private companies who are already working in the renewables, such as solar or wind, in a country, taking Uganda as an example, then what is the competitive value proposition of an oil and gas company versus a power utility? So that's one thing to think about. What are we bringing to the table? I think some things you can bring to the table is, for many NOCs, you have expertise in project management, you have technology, technical expertise, know-how, which can then be retrained or used for other kind of energy production. The other question would be, what is the balance of the asset and the returns? Because if you already have an existing oil and gas development underway, either producing or coming online, can you really, allocate capital to doing something else at the same time? I think you have to be very careful and not just jump on the bandwagon to become a solar and wind producer. Solar and wind, and mostly solar in their own operations. If you can use renewable energy, it has sort of a win-win, because you're reducing the emissions, but also you're getting some experience. And that could be a way to get into and then grow that to become a standalone business.
Mm-hmm. And some companies like Sonatrach have found that investing in renewables is a way to meet domestic demand and free more oil or gas for export.
Would you advise that this is the time for governments to reduce their level of state participation in development projects in order to reduce on the risk?
That could be, definitely, that could be one option, right? I mean, it has some advantages and disadvantages, because you lower the participation, then your future kind of profits and returns can come down, but you're then, as you rightly say, you're spreading the risk. And for some companies, that may be actually more attractive if they have a bigger share. It's more interesting for them to participate. So I think it will all depend upon the situation. But that could be one strategy. My own personal view is that I think the regulations are the #1 priority for the for these companies as to what is the framework under which they are coming, the contractual framework under which they're going to make the investment. Because limited money and lots of opportunities, so they're always going to be prioritizing where do they go next.